Colleague said, joining us is Herry Cho, Managing Director, Head of Sustainability and Sustainable Finance for SGX Group. We have about 20 minutes for the conversation and a couple of areas that we want to cover. We'll start with transition finance. It's an area that's been challenged often by a lack of one single specific definition. So tell me, what does transition finance mean for you and for SGX Group, and how has that lack of a clear definition presented challenges?
Thanks, David. So I understand that we've got some virtual audience from around the world as well joining. So for those who are not familiar with SGX Group, we are the Singapore Exchange Group, and we're a multi-asset exchange, not only with equities, but derivatives, fixed income, a JV with carbon markets, FX, among other instruments. Now, transition finance, very topical. And one thing we can say is that Asia embraced the need for transition quite early, as many of the experts in the room here would know. And the need to have some level of common definition and understanding what transition finance is transpired quite early on. I remember when we were starting to work on actually Singapore Asia taxonomy in 2019. There were quite a bit of discussion on how to tackle that, because at that time the EU taxonomy actually did not include transition, right? So a lot of thought went in, and very thoughtful inputs to define what that means. And what we see today, and of course taxonomies is not the only proliferation of definition, and that's one of the challenges we see. But if you look at the definition of the taxonomy for Singapore, not only Singapore, but also other parts of Asia, you're starting to see what it means to have, for example, amber category, which is that transition definition. So, for example, in steel sector, we all know, a new tech that's yet to be fully commercialized, like electric arc furnace, will be green, but there are further definitions on what makes an EAF green, but also amber, and there's a sunset date as well, like 2030, before it can actually no longer be a transition asset.
Quite. You mentioned steel, among the sort of hardest to abate sectors. What can exchanges do? What role do exchanges have, among others, to encourage that flow of finance to hard to abate sectors? That's really the sort of key challenge. What's the role of an exchange like SGX?
So, an exchange is an interesting place to be, because in many ways you're at the heart of the ecosystem where so many players come together. Now, one of the roles that we defined early on is we have to support the mobilization of capital when it comes to transition finance. And a unique challenge that exchanges have to look at is a key conundrum that transition finance actually faces, which is that we have to understand the definition of transition at the securities level, so the issuer level, rather than project by project level, right? And one of the key buckets that we see where the financing really needs to take this into account as well is index-based investing and index-based risk mitigation tools as well. So, we put up our hand to be a co-chair of, and in fact played a key role in devising what needs to be done by the industry overall for a global work stream called Transition to Net Zero Index Investing under GFANZ, the Glasgow Financial Alliance for Net Zero, which is also supported by Bloomberg, amongst many other financial institutions as well. And many different actors came together, asset owners, asset managers, index providers, exchanges, to actually come up with a guidance that leverages upon some work that asset owners did and asset managers did already. And so some sort of framework and guidance for best practices is going to come out for public consultation in October. at PRI in person in Toronto. But taking that to a practical level as well, just going back to that issuer level definition and going back to the example of steel, David, what's extremely important and coming out from what asset owners and like pension funds, etc., are saying is we can not only invest in green because that is like 5% of the overall economy. Yeah. And so how do you actually not exclude the sectors that's hard to abate? And therefore, we've been working with industry partners to define indices where you can actually put AUM behind or use those hedging tools as well, where actually you're not excluding, you're not making it a low carbon index, but you are actually giving more weight to players within a sector. So there's no sectoral exclusion, there's no geographic exclusion, but there is actually preferential weighting or actually cutting off of the lower 50% and only including the top 50% within a sector, right? For those who are actually meeting some of the criteria, whether that be they have science-based targets in place, green revenues in place, that the management has readiness on actually implementing some of this, and of course that's after certain exclusions. So we're trying to resolve, although nothing is perfect at that issuer level, how do you actually continue to fund that transition?
Do you see tools like that, mechanisms that can offer assurances, do you see that having an impact in terms of persuading investors who may remain reluctant to put money to work in heavy emitting industries?
Yeah.
Do you see that having an impact and encouraging people to maybe rethink some of the restrictions they may have placed on investments previously?
Well, I suppose, David, the question is what came first, right? So there are many investors, whether it's global or more emerging markets focused investors, who have been saying, or they're looking for a path as to how to implement it. We all know that Paris Agreement is trying to aim towards 2050, right, on average. But it also does say in Paris Agreement that there are common but differentiated responsibilities by sovereign actors. But often when it comes to companies or corporate actors, it's on a global basis, often is treated the same. So how do you actually practically embed that in a credible way? And so in some of the ways that investors have been doing it is they do have differentiated approach between emerging markets and developed markets. Some global investors even say that certain hard-to-abate sectors, companies in the development markets, there's no excuse if they only have commitment but are not showing action against the commitment, achieving those commitment. Whereas in emerging markets, they may be a bit more lenient on the timeline on what needs to be achieved, as well as taking into context the nationally determined contributions or the sovereign level as well. So I think we are some of this technical work that is ongoing and sort of new suite of transition to net zero products that we're seeing are actually in response to demand by investors. But if I just may add one more, the regulatory field is not making it any easier. Some of you may have seen just last week on 24th of July, ESMA, the European Securities and Market Authority, gave an opinion on their views on sort of long-term development of sustainable finance in the EU, and they did opine that they believe that SFDR should be phased out over time and replaced by EU taxonomy as a common definition, right? And so whilst that was regulatory driven, the land beneath our feet, it's almost like we are sort of doing the mechanics as we drive at the same time, right? That's the reality of the field that we're all working in, but it's an important work.
That sort of brings us to regulation, to disclosure. Here in Singapore, the regulatory arm of the exchange is talking to the market about how to incorporate ISSB standards. What impact do you foresee that could have, both positive, and in terms of adding an additional burden of compliance for those listed here?
Sure. So not to say that we should not take action until data is perfect, but data it's unfortunately true. Without good data, good comparable data, we're not going to be able to measure, practically the transition that we need to undergo. And so with that in mind, we were really quite heartened to see that there was an international acceptance, and certainly from securities markets and exchanges perspective, IOSCO has been involved right from the beginning on endorsing ISSB and giving inputs from the beginning, including MAS from Singapore as well. And so ISSB, or International Sustainability Standards Board, is a set of level setting on sustainability disclosure, which Singapore has also, from regulatory perspective, have announced to adopt. It will be undertaken for 2 set groups. So, of course, the listed companies, and I see a number of listed company experts in the room here as well. We've already been a market that had a mandatory sustainability reporting regime since 2016, and it was further fortified to include TCFD since 2022. From financial year 2025's reporting, it's going to be mandatory to do climate-related disclosure based upon ISSB 2. In Singapore, it's not only going to be for listed companies. The private companies that's incorporated here above certain size, for example, more than $1 billion in revenue, will also have to do it, but under slightly later timeline for financial year reporting starting 2027.
And just briefly, is there a risk in markets that may have a differentiated approach, or for Singapore to be an earlier adopter of these standards? This is a market where we've seen company listings decline over time. Is the prospect of more onerous compliance, more onerous regulation, is that a risk to any ambition to see that rate of company listings increase?
Yeah. So, the other thing that I find as an exchange is that for every action that an exchange takes, everything has to be taken in balance. And so when this, regulation was being launched as well, of course, there were open consults. I hope many of you had responded to that as well, which is now closed, and we're now undertaking the work to put it into listing rules. It is a consideration. How do you make sure that you do not create overly onerous requirements so that companies might be deterred from coming to a market that's transparent and helping investors understand some of the emerging opportunities and risks that sectors and companies face, right? So that's certainly been taken into account, and what's coming out and the rules that's been coming out is something that takes that into account as well. But having said that, there has been, broadly speaking, support in the market, even for the TCFD disclosure, and had that going into regulations, there has been significant support by the majority of the market for the implementation.
That's great. If I can take you to sort of products and opportunities, in terms of sort of new offerings, new product offerings, where has SGX seen, I guess, the strongest growth? And where do you see the best opportunities from here, to whether that's adding new products, extending some of the offerings that you currently have?
Yeah. Okay, so I think one topic that's always been very popular for at least last 4 years is carbon markets, right? Which has also gone through quite choppy, volatile market that's been actually quite unprecedented if you're a market player, solely looking at carbon markets. One thing that we would say about carbon markets is whilst there's been sort of 2 ends of the spectrum as to whether carbon credits and carbon markets are credible, and on the other side saying they are very important, on balance, how we see it is that carbon credits done the right way is an instrument that can belong in a decarbonization toolkit to make sure that funding really actually goes to projects where it needs to go, especially in emerging markets, right? And so that's why, yes, markets will never be linear, and making sure that this is the crux of greenwashing, right? Ensuring that any instruments, including carbon credits, does what it says on the tin, right? So that's some of the work that's been ongoing, and Climate Impact X, which is one of our JV companies, have been playing a role in ensuring that the credibility in the credits that they offer are there as well. But so long as some of these important boxes are ticked, we should continue to develop how that instruments can play a role. But more broadly speaking, David, I think, just when it comes to emerging markets, that transition that need to undergo, and taking into consideration the socioeconomic balance, how does that translate in concrete terms into instruments that actually pull in capital, right? And so just one example where we have been doing deep work with is an example with MSCI, where an index was devised to look at, specifically, what it actually means to have a company to be undergoing good transition, right? And working through how can the methodology be as transparent as possible. So making sure there's key transparency in some of these instruments is also another important point.
Fantastic. Just briefly, as I'm conscious of time, in terms of other opportunities, very broadly, derivatives, obviously a huge opportunity for all manner of exchanges, not only in sustainable finance, but when it comes to sustainable finance, what are the opportunities there? Weather derivatives have been, incredibly popular, had a bit of a moment in the spotlight in recent months. Is that an opportunity for Singapore? And briefly, sort of, what are potentially some of the other new product areas you could explore?
Yeah. So, it does happen to be that we are a big derivatives market, both for equities and commodities as well, cash-settled derivatives in commodities. So when it comes to equity, I don't know whether some of you have been following, but there's been some very interesting discussions, including weigh-ins from certain regulators as well, as to how derivatives, whether it's long or short, should be accounted for when it comes to accounting for GHG footprint. So should you, when you look at a total position, should it be a net position? Should you be adding in the long position? Should you be netting off the short position, So that kind of thing from GHG perspective, it's a very live conversation. But, when we come to the practical just usage, right? Derivatives are just in use because there's many different roles that derivatives can play, whether that's cash equitization for, cash that the treasury team has, or you want a certain exposure, at a more, with a smaller quantum, right? Directional exposure. So you can still utilize the way that derivatives get used and layer on the climate component to make that happen as well. On the commodities front, there are many players, like, for example, in the electric vehicle value chain, who have, for example, need to procure lithium, or cobalt, because those are key components of batteries. And sometimes they don't have, the market has been super volatile, at times increasing by 3 times, right, in a space of 1 year. So we've been launching some hedging tools to help mitigate the pricing risk of some of these key commodities.
Fantastic. We're just about out of time. And so if you could join me in just saying thank you to Herry Cho. Really interesting conversation. And you'll hear next from my colleague Lauren Keel with our next conversation. So please join me in